Before we begin, it's crucial to state that I am not a licensed financial advisor or insurance agent. This presentation is intended for educational and informational purposes only and does not constitute financial, legal, or insurance advice. The world of insurance is complex and highly regulated. You should always consult with a qualified and licensed professional who can assess your individual circumstances and provide personalized guidance before making any decisions regarding your policy. Imagine this for a second. You get into a fender bender. It's not your fault. You do everything by the book, you exchange information, you take pictures, you file the police report, and you call your insurance company, relieved that you've been paying your premium every single month. But that feeling of relief evaporates when you get on the phone. The agent on the other end tells you that your policy, the one you bought because it was the cheapest quote you could find, doesn't cover a rental car, leaving you stranded. Or maybe they tell you that your collision deductible is actually $2,000, not the $1,000 you thought it was. Or, in the worst-case scenario, they find a loophole, a tiny exclusion in the fine print, and deny your claim altogether. Suddenly, that $100 a month you were saving has morphed into a $5, $10, or even $20,000 nightmare. This isn't just a scare tactic. For millions of Americans, this is the harsh reality of a single critical mistake: choosing the wrong type of insurance company. The biggest gamble you can take with your financial future has nothing to do with your coverage limits or your deductible. It's about not understanding the fundamental difference between a major, standard insurance carrier, think Progressive, State Farm, Geico, and a non-standard carrier, the companies you often see advertising cheap insurance for any driver. And making the wrong choice can be the difference between a minor inconvenience and absolute financial devastation. That's why we're here today. We are going to pull back the curtain on the entire auto insurance industry. We're going to demystify the jargon, expose the hidden risks, and give you the knowledge to make an informed decision. By the end of this, you will understand exactly what separates these two worlds of insurance. You'll know who the non-standard companies are really for, why their prices seem so low, and what you're truly giving up in exchange for that cheaper premium. Most importantly, you will learn how to identify which category is right for you, potentially saving you not just hundreds of dollars a year, but thousands of dollars in a future claim. So, what is the single biggest difference? It's not the commercials, it's not the mascots, and it's not even the price, at least not directly. The number one difference, the one that dictates everything else, is who they are designed to insure. It all comes down to one word: risk. Every insurance company operates by creating something called a risk pool. Think of it like a giant community fund. Everyone in the community pays into the fund each month, and when someone has a bad day and crashes their car, the company uses the money from the fund to pay for the damages. If the company is good at its job, it takes in more money in premiums than it pays out in claims, and that's how it makes a profit. Now, major standard insurance companies, the big household names, want their risk pool, their community fund, to be filled with the safest, most predictable drivers possible. They are incredibly selective. They want drivers with clean records, great credit scores, no DUIs, no at-fault accidents, and no gaps in their coverage history. They spend billions of dollars on advertising to attract what they call preferred risks. Why? Because these drivers are statistically far less likely to get into an accident and file a claim. They are a safe bet. When you have a pool full of safe bets, you don't have to pay out as often. This means the company can afford to charge everyone in the pool a lower premium and still make a healthy profit. It also means they have the resources to offer better service, more coverage options like rental reimbursement and accident forgiveness, and a smoother, faster claims process. It's a business model built on attracting low-risk customers and rewarding them with competitive prices and premium service. But what happens if you're not a preferred risk? What if you've had a couple of accidents? What if you got a DUI 5 years ago? What if you're a new driver with no history? Or your credit score took a hit during a tough time? What if you let your insurance lapse for a few months because you were between jobs? To a standard insurance company, your application flashes with red lights. You represent a higher statistical probability of filing a claim. You are, in their eyes, a high-risk driver. And so, they will either deny your application outright or give you a quote so astronomically high that it's their polite way of saying, "Please go somewhere else." This is where the non-standard auto insurance market comes in. These companies were created to serve the exact people the standard market rejects. Their entire business model is built around insuring high-risk drivers. They willingly accept applicants with DUIs, multiple at-fault accidents, State Route 22 requirements, poor credit, or lapses in coverage. They provide an absolutely essential service. Without them, millions of people who are legally required to have insurance to drive to work and live their lives would have no options at all. But to do this, they have to manage a risk pool that is, by definition, filled with drivers who are statistically much more likely to file claims. Their community fund is inherently more volatile. So how do they stay in business? They have to do two things. First, they have to charge higher premiums for the same amount of coverage compared to what a preferred driver would pay at a standard company. That's just simple math. More risk equals higher cost. Second, and this is the part that trips up so many people, they have to strictly limit what they pay out. They do this by offering what are often called basic or bare bones policies. These policies are designed to meet the absolute minimum legal requirement to drive in your state, and not much else. This is the critical misunderstanding. People see a cheap quote from a non-standard company and compare it to an expensive quote from a standard company and think they're getting a great deal. They believe they're buying the same product, car insurance, for less money, but you are not buying the same product. You are buying a completely different product designed for a completely different type of customer. A non-standard policy is engineered from the ground up to minimize the insurer's payout. The deductibles are often higher. The coverage limits are often lower. The exclusions for what is and isn't covered are more numerous and more restrictive. The customer service and claims departments are often under-resourced because, frankly, paying out claims is a cost they are trying to aggressively control. Let me be clear. This doesn't make non-standard companies bad. They are playing a different game with a different set of rules, serving a market that the big players won't touch. The problem arises when a low-risk or standard driver, someone who could qualify for a great policy with a major carrier, is lured in by a seemingly cheap non-standard quote without understanding the trade-offs. They think they're saving money, but what they're actually doing is taking on a massive amount of personal financial risk. They are paying for a flimsy safety net that might have giant holes in it, holes they won't discover until they're already falling. So, the fundamental difference, the DNA that separates these two types of companies, is the risk pool they are built to manage. Standard carriers are exclusive clubs for low-risk drivers, offering better perks and prices as a reward. Non-standard carriers are the essential, no-frills option for high-risk drivers, providing the basic coverage required by law, but at a price that reflects their increased risk. Understanding which pool you belong in is the first and most important step to protecting yourself on the road and in your wallet. The name on your insurance card matters far less than the type of risk pool it represents. So let's pull back the curtain on that first pool, the one everyone wants to be in, the standard market. When you hear names like State Farm, Geico, Allstate, Progressive, or USAA, you're thinking of standard or preferred insurance carriers. These are the titans of the industry, the companies with billion-dollar advertising budgets that blanket the airwaves with catchy jingles and memorable mascots. But behind the friendly gecko and the reassuringly deep voice is a ruthlessly efficient, data-driven machine designed to do one thing: identify and insure low-risk individuals. Their entire business model is built on the law of large numbers. They want to insure millions of people who are statistically unlikely to ever file a major claim. By gathering a massive pool of these good risks, they can spread the cost of the few claims that do occur across a vast base of premium-paying customers. This allows them to offer competitive rates and still turn a healthy profit. To them, you are not a person. You are a collection of data points, and their goal is to determine if your data profile fits their profitable model. So, who is their ideal customer? Let's call her Sarah. Sarah is 38 years old, married with 2 kids, and lives in a quiet suburban zip code. She owns her home and has been with her previous insurance company for 7 years with no claims and no late payments. She has a credit score of 810. She drives a 5-year-old Toyota Highlander, a vehicle known for its safety ratings and reliability, not its speed. Sarah is, in the eyes of a standard insurance company, the perfect risk. Every single data point about her screams stability, predictability, and responsibility. When she applies for a quote, the insurance company's complex algorithm sees her and essentially rolls out the red carpet. They will fight each other for her business, offering discounts for bundling her home and auto, for being a safe driver, for being a loyal customer. Why? Because they predict that over the next 10 years, Sarah will faithfully pay her premiums and most likely cost them nothing. She is pure profit. The process of deciding whether you're a Sarah is called underwriting, and it's far more invasive than most people realize. Standard carriers are data vampires. They look at your driving record, obviously. Any at-fault accidents, speeding tickets, or DUIs in the last 3 to 5 years are massive red flags. But that's just the start. They pull your credit-based insurance score. Now, this is a critical point that trips a lot of people up. They aren't checking your credit to see if you can afford the monthly premium. They are using your credit history as one of the most powerful predictors of future insurance claims. Decades of data have shown a strong statistical correlation. People with lower credit scores file more claims, and often more expensive claims, than people with higher credit scores. The reasons are complex and debated. Perhaps it's a general indicator of responsibility, or maybe people with less financial cushion are more likely to file a claim for a minor fender bender rather than pay out of pocket. But the why doesn't matter to the insurance company. The what, the cold, hard data, is all that counts. A low credit score tells their algorithm that you are, statistically speaking, a higher risk. It's not personal, it's just math. Next, they look at your insurance history. Have you had continuous coverage for the past several years? A lapse in coverage, even for a few weeks, is a gigantic red flag. To them, it signals instability. Maybe you couldn't afford it, maybe you forgot, or maybe you were driving uninsured. Whatever the reason, their data shows that drivers with lapses in coverage are significantly more likely to be in an accident. They also look at where you live. A person living in a dense urban area with high rates of theft and accidents will pay a much higher premium than someone with the exact same profile living in a rural county. They analyze the car you drive. A sensible sedan costs less to insure than a high-performance sports car, not just because of the potential for speeding, but because repair costs, theft rates, and even the typical psychological profile of the driver are all baked into the rate. Even your marital status and whether you own a home are factored in. Married homeowners are, statistically, the safest and most stable drivers on the planet. They file the fewest claims. This is why the bundle and save discount is so much more than a marketing gimmick. When you bundle your home or renter's insurance with your auto policy, you are sending the carrier a powerful signal. You're telling them you are stable, you have assets to protect, and you're a rooted member of your community. You are a lower risk, and you are also a stickier customer. Someone less likely to shop around and switch companies every 6 months. You are the ideal. This entire underwriting process is a gauntlet designed to weed out anyone who deviates from that Sarah profile. The standard market's greatest fear is what's known in the industry as adverse selection. This is the nightmare scenario where, for some reason, all the high-risk drivers end up in their low-risk pool. If that happens, claims start pouring in at a rate far higher than their models predicted. To cover these costs, they would have to raise premiums for everyone in the pool. But when they do that, the good risks, the Sarahs of the world, will see their rates go up and immediately leave for a competitor who is still offering a lower price. This exodus of good drivers leaves an even more concentrated pool of bad risks, forcing the company to raise rates again. This vicious cycle is called an insurance death spiral, and it can bankrupt a company. So their strictness isn't about being mean or judgmental. It's a survival mechanism. They must protect the integrity of their risk pool to keep their prices competitive for their target audience. They are guarding the gates of a very exclusive club, and they only want members who won't cause any trouble. Now let's consider another driver. Let's call him Mike. Mike is 22 years old and just got his first real job. He loves cars and just bought a 10-year-old Mustang GT. He's had his license for 5 years, and in that time he's had one speeding ticket and a small fender bender that was his fault. Because he was in college and money was tight, he let his insurance lapse for about 4 months last year. His credit is still developing and sits at around 590. When Mike goes online to get a quote from the same big-name company that gave Sarah a fantastic rate, his experience is different. He enters his name, his address, his driver's license number. The algorithm goes to work. It sees his age, high risk. It sees his vehicle type, a V8 Mustang, high risk. It sees his driving record, a ticket and an at-fault accident, high risk. It sees the lapse in coverage, very high risk. It sees his credit score, very high risk. Within seconds, a message pops up on his screen. We're sorry, but we are unable to offer you a policy at this time. There's no negotiation, no person to talk to. The computer has simply looked at his data profile and concluded that he does not fit their profitable model. He is not a Sarah. He represents uncertainty, unpredictability, and a high statistical probability of costing them money. To protect their pool, their shareholders, and their low-risk customers, the gate slams shut. Mike has been rejected by the standard market. He's still a good person. He needs to get to work just like Sarah does. He is legally required to have car insurance. But the companies he sees on TV every single day don't want his business. So where does a driver like Mike turn? What happens when you're deemed too risky for the preferred world? He turns to a world that operates in the shadows of the mainstream insurance industry. A world that doesn't buy Super Bowl ads or have catchy jingles. This is the non-standard auto insurance market. And for millions of drivers like Mike, it's not just an option. It's the only option. The term non-standard sounds a little intimidating, maybe even a bit shady. But it's not. It's simply a category, a classification for a segment of the market that specializes in covering risks that the standard, or preferred, market, the world of Geico, Progressive, and State Farm, is unwilling to take on. Think of it like this. A five-star hotel and a budget motel both offer you a place to sleep. They serve different customers with different needs and different budgets, but they both fulfill a fundamental purpose. The standard insurance market is that five-star hotel. It wants guests with perfect credit, no history of trouble, and the ability to pay up front for the year. It's clean, simple, and predictable. The non-standard market is the motel down the road. It's not as glamorous, the amenities are fewer, but it provides an essential service to people who have nowhere else to go. It understands that life gets messy. So who are these drivers? Who is Mike? On the surface, he's just a regular guy. He works in construction, he's a good dad, he pays his taxes. But to an insurance underwriter, his history reads like a rap sheet of red flags. 3 years ago, he went through a nasty divorce. Stressed and distracted, he racked up 2 serious speeding tickets in 6 months. Then one rainy afternoon, he slid through a stop sign and rear-ended a sedan. It was a low-speed collision, nobody was hurt, but it was definitively his fault. That's strike 1. A recent at-fault accident and multiple moving violations. Around the same time, the financial strain of the divorce and setting up a new household became overwhelming. He missed a few credit card payments, then a car payment. His credit score, once respectable, plummeted. For insurers, this is a massive red flag. Actuarial data, stretching back decades and covering millions of drivers, shows a strong, undeniable correlation. People with lower credit scores are statistically more likely to file claims. It doesn't mean Mike is going to file a claim. It doesn't speak to his character. It's just cold, hard data. An algorithm sees his credit score and flags him as a higher financial risk. That's strike 2. Finally, during that turmoil, there was a 2-month period where he just couldn't make his insurance payment. The policy was canceled for non-payment. He had a lapse in coverage. To an insurer, this is one of the biggest sins. It signals instability. It creates a gap in his insurance history. It tells them that he might be the kind of customer who only pays when he has to, and might stop paying at any moment. This is strike 3. And the nail in the coffin? Because of his driving record, the state DMV has now mandated that he carry in State Route 22. And State Route 22 isn't actually insurance. It's a special form, a certificate of financial responsibility, that his insurance company has to file with the state on his behalf. It's basically the insurance company vouching for him, telling the state, yes, we are covering this high-risk individual. If we cancel his policy for any reason, we will notify you immediately. It's a scarlet letter in the insurance world, and most standard carriers won't even touch a driver who needs one. So Mike is the perfect storm. A problematic driving record, poor credit, a lapse in coverage, and in State Route 22 requirement. When he fills out an online quote form for a major carrier, the computer algorithm takes about 3 seconds to analyze these 4 data points and spit out its verdict. Decline. Denied. We are unable to offer you a policy at this time. This is where the non-standard companies step in. Companies with names you've probably never heard of: the General, Safe Auto, Dairyland, 1,000 other smaller regional players. Their entire business model is built around insuring Mike. They don't see him as a liability to be avoided. They see him as their target demographic. They have spent decades building their own set of actuarial tables, specifically designed to calculate the precise financial risk of a driver with 2 tickets, 1 accident, a 550 credit score, and in State Route 22 requirement. They don't decline him. Instead, they price him. They manage their own risk in a few key ways. First, and most obviously, the premiums are significantly higher. They are taking on a greater statistical chance of paying out a claim, so they have to charge more to cover that potential loss and still make a profit. Where Sarah might get a quote for $120 a month for great coverage, Mike's quote for the bare minimum legal liability coverage might be $300, $400, or even more. Second, the coverage options are often more limited. These companies specialize in getting drivers legal. Their primary product is the state minimum liability policy. You can often still get comprehensive and collision coverage, but the deductibles might be higher, think a $2,000 deductible instead of $500, and the terms might be stricter. They aren't in the business of offering fancy bells and whistles like accident forgiveness or vanishing deductibles. This is about pure, functional, legal-to-drive insurance. Third, and this is a crucial difference, they are built for their customers' financial reality. They understand that a driver who can't afford a $1,500 annual premium in one lump, some might be able to handle $90 a week. So they offer incredibly flexible payment plans. Monthly, bi-weekly, even weekly payments are common. They cater to a cash flow-based customer, not a savings-based one. This flexibility is often the single most important feature that makes getting insured possible for someone in Mike's position. So, after a week of frustrating rejections, Mike finally talks to an independent insurance agent, an agent who works with dozens of companies, not just one. The agent listens to his story, nods knowingly, and says, "Okay, the standard markets won't work. Let's look at some non-standard options." He punches Mike's information into his system. He doesn't get a rejection. He gets 5 different quotes. Mike looks at the numbers and his heart sinks. The cheapest option is $380 a month. That's over $4,500 a year for a basic policy on his 10-year-old truck. It's a staggering amount of money. It's more than his truck payment used to be. He feels a flash of anger, of injustice. How can it be so expensive just to be legal? But then beneath the price he sees the words, "Policy approved." He sees the option for a low down payment and monthly installments. He sees the agent confirming that yes, they will file the state Route 22 with the state for him, getting his license fully reinstated. The price is painful, but the alternative is worse. Not being able to drive to work, not being able to pick up his kids, the constant fear of being pulled over and facing thousands in fines or even having his truck impounded. For Mike, $380 a month isn't a punishment. It's the price of admission back into normal life. It's a solution. It's the only path forward. He takes a deep breath and tells the agent, "Let's do it." He pays the first month's premium and the policy is active immediately. The agent prints out his new insurance card. For the first time in months, Mike is a legally insured driver. A massive weight lifts from his shoulders. He's paying a fortune, but he's covered. Or is he? Because the price you pay and the company name on the card is only half the story. The other half, the part that truly matters, is what happens when things go wrong. What happens when you actually need the protection you're paying so much for. And for Mike, driving home from the agent's office with his new policy in hand, things are about to go very, very wrong. The light was green. Mike was sure of it. He'd been replaying the last 30 seconds in his mind for what felt like an eternity, but the image was seared onto his brain. The green light, the gentle hum of the radio, the thought of what he'd have for dinner. Then a flash of red from his left. A blur of motion where there should have been nothing. The world wasn't a symphony of shattered glass and twisted metal, like in the movies. It was a single deafening percussive bang. A gut-wrenching, bone-jarring punctuation mark at the end of a perfectly normal day. His head snapped back against the rest, then forward. The seatbelt, his silent partner in daily commutes, dug into his collarbone with brutal efficiency. The airbag exploded from the steering wheel, a violent, powdery cloud that smelled of chemicals and burnt corn. For a moment there was only silence, replaced by a high-pitched ringing in his ears. He blinked, tasting the acrid dust in his mouth. His new insurance card, the one he just placed in his glove box, felt a million miles away. The other car, a late-model SUV, was embedded in his driver's side door. Steam hissed from under its crumpled hood. Mike's own car, a reliable sedan he'd meticulously maintained, was a wreck. He fumbled with his seatbelt, his hands shaking uncontrollably. He pushed open the passenger door, which groaned in protest, and stumbled out onto the pavement. The other driver, a woman in her 40s, was already on her phone, her voice frantic. He was sore dazed, but he seemed to be in one piece. That was the first miracle. After the police arrived, took statements, and the tow trucks were called, Mike stood on the side of the road, watching his car get winched onto a flatbed. It looked pathetic, a wounded animal being dragged away. The reality was crashing down on him harder than the SUV had. He was carless. He was shaken. And now he had to make the call. He pulled out his phone and looked at the brand new insurance card from Apex Assurance. The logo was a bold, soaring eagle. It was meant to inspire confidence. Right now it just looked like a bird. He dialed the claims number. The first thing he heard wasn't a reassuring human voice. It was a tinny robotic menu. For a new claim, press 1. For an existing claim, press 2. He pressed 1. Then came the hold music. It wasn't a soothing classical piece or a gentle jazz tune. It was an upbeat synthesized pop track on a 10-second loop. It was the kind of music designed to slowly drive a person insane. 5 minutes passed. Then 10. Each loop of the chirpy, soulless music felt like a small mockery of his situation. Finally a click. Apex claims, "This is Brenda. How can I help you?" Her voice was flat, devoid of any emotion. It sounded like she was reading from a script at the end of a very long shift. Mike took a breath. "Hi, yes. My name is Mike Thompson. I need to report an accident. It just happened. Policy number?" She asked, no empathy, no "Are you okay?" Just a demand for data. He read it off the card. He could hear her typing, the clatter of keys echoing down the line. "Okay, Mr. Thompson. I need to inform you that this call will be recorded for quality assurance. Do you consent to this recording?" Yes, of course." "Okay. State the date and time of the incident." He told her. Location of the incident? He gave her the intersection. Were the police contacted? Yes, they were here. They just left. Officer's name and badge number? I have it in the report they gave me. Hold on. He fumbled with the piece of paper the officer had handed him. His hands were still trembling. "Sir, I need you to be concise. We have many calls to get through." The words hit him like a slap. Many calls to get through. He wasn't a person in crisis. He wasn't a customer who had just been through a traumatic event. He was a task. A ticket in a queue to be processed and closed. The $70 he'd saved on his premium suddenly felt like the most expensive $70 of his life. He gave her the officer's information. Then she began a rapid-fire series of questions about the accident, about the other driver, about points of impact and road conditions. Her questions weren't open-ended. They were pointed. "So you were proceeding through the intersection. Were you monitoring all cross-traffic prior to entering?" It felt less like an investigation and more like an interrogation. It felt like she was looking for a reason, any reason for this to be his fault. "Now," she said, her tone unchanged, "regarding your vehicle, we do not send adjusters to the scene. You will need to have your vehicle towed to a licensed repair facility for an estimate. Do you have a preferred shop?" "Yes," Mike said, relieved to finally have some control. "I've always taken my car to a place called Dave's Auto Body. They do great work." A pause. More typing. "I'm not showing Dave's Auto Body on our approved network list, sir." "What? What does that mean?" "It means you can take it there, but we cannot guarantee payment on their labor rates or part selection. If they charge more than our approved network rate, you will be responsible for the difference. To guarantee coverage, you must take it to one of our Apex-certified collision centers." "Okay," Mike said, his heart sinking. "Where are they?" "The closest one to your location is Precision Panel and Paint in Rosedale." Rosedale? That was 40 miles away, in an industrial park he'd never even heard of. "There's nothing closer? I live right here." "Sir, that is the closest in-network facility with an available appointment. I can schedule you for an estimate in 9 days." 9 days? Mike's voice cracked. "What am I supposed to do for 9 days? I need a car to get to work. What about a rental?" He could almost hear the agent sigh through the phone. "Sir, as per your policy, rental coverage is on a reimbursement basis only. You would have to pay for the rental car out of pocket. Once our liability investigation is complete, if you are found to be not at fault, you can submit your receipts for consideration. The investigation typically takes 30 to 45 business days." 30 to 45 business days. He would have to pay for a rental car for over a month out of his own pocket, with no guarantee he'd ever see that money again. The whole world seemed to be tilting on its axis. He was standing on the side of a busy road. His wrecked car was gone, and the company he was paying to protect him was offering a masterclass in bureaucratic indifference. They weren't a safety net. They were a maze of tripwires and loopholes. "Okay," Brenda said, her voice signaling the end of the call. "You'll receive a welcome packet by email with all of this information and your claim number. An adjuster will be assigned and will contact you within 72 business hours to take your full recorded statement. Do you have any other questions?" Mike's mind was a blank. He had a million questions, but he knew none of them would be answered by her. He felt utterly, completely alone. "No," he mumbled. "No other questions. Thank you for calling Apex Assurance. Have a nice day." The line went dead. He stood there for a long moment, phone in his hand, the traffic whizzing by. A nice day. She had told him to have a nice day. He looked at his phone, the screen now showing his home screen. The email from Apex had already arrived. The subject line read, "Your new claim. APX 75B3492. He wasn't Mike Thompson anymore. He was a number. And as he stood there trying to figure out how he was even going to get home, his phone began to ring again. It was an unknown number from an out-of-state area code. He almost ignored it, but something told him to answer. Hello. The voice on the other end was the polar opposite of Brenda's. It was sharp, professional, and dripping with confidence. Am I speaking with Michael Thompson? Yes, this is he. Mr. Thompson, my name is David Chun. I'm a claims representative with Progressive Insurance. I'm representing our insured, Sarah Jenkins, the other party involved in your accident a short while ago. I just want to let you know that we've already spoken with our client, accepted full liability for the incident, and I'm calling to get your vehicle repair and rental car set up for you immediately. First, are you injured in any way? Mike was stunned into silence. The other driver's insurance company, a major standard carrier, was calling him before his own adjuster had even been assigned. They were accepting fault. They were offering a rental car. They were asking if he was okay. They were doing everything he had desperately hoped his own company would do. And in that moment, a cold, terrifying thought washed over him. The other driver's insurance was about to treat him better than his own. That thought barely had time to crystallize before his phone rang again. It was an unfamiliar number, but from the same area code. He answered, his voice still shaky. The woman on the other end was calm, professional, and immediately reassuring. She introduced herself as Sarah, a claims representative from, and he could hardly believe it, the other driver's insurance company, a major household name carrier. Before Mark could even process what was happening, she was already in motion. She had the police report number. She had his name. She had the other driver's statement admitting full fault. She wasn't asking him for information. She was giving it. She told him a tow truck had already been dispatched for his vehicle and asked where he'd like it taken. She asked if he was injured, if he needed to see a doctor, and explained that his medical evaluation would be covered. She told him they had a direct bill partnership with a rental car agency, less than a mile from his location, and that a reservation for a mid-size sedan was already waiting for him under his name. He just needed to go pick it up. He was speechless. This entire complex, terrifying event was being deconstructed and solved for him piece by piece by the one company he thought would be his adversary. She gave him a direct phone number, her personal extension, and a claim number, telling him to call anytime. The call lasted less than 10 minutes. Hanging up, Mark felt a wave of relief so profound it almost brought him to his knees. Someone was in control. Someone was handling it. But that relief was immediately tainted by a sour, creeping dread. He still hadn't heard from his own insurance, the company he paid every single month. He pulled up their number and called. And that's when his education truly began. First, the automated system, a labyrinth of options. Press 1 for new quotes. Press 2 for billing. Press 3 for claims. He pressed 3. Please enter your 14-digit policy number. He fumbled for his insurance card. He typed it in. I'm sorry, that number was not recognized. Please try again. He did. Again it failed. After the third try, the system announced it was transferring him to a representative. He was then on hold for 47 minutes. 47 minutes of grating, low-fidelity music, interrupted only by a recorded voice telling him how important his call was. When a man finally answered, he sounded bored and distracted. Mark explained what happened, his voice filled with the stress of the last few hours. The agent, whose name was apparently Steve, didn't ask if he was okay. He didn't offer any comfort. His first question was, "Did you obtain the other party's insurance information?" Mark said yes. Steve's second question was a police report filed and do you have the report number? Mark, thanks to the other driver's insurance agent, had it ready. There was a long pause filled with the sound of typing. Okay, Steve said, his voice flat. So it looks like the other driver is at fault. Mark agreed. Well, Steve continued, in that case, you'll need to file a claim with their insurance to cover your damages. Mark was stunned. What? But I pay you. My car is totaled. I need help now. I need a rental car. The other agent already set one up for me, but shouldn't you be doing that? Another pause. More typing. Sir, your policy does not include rental reimbursement coverage. And since the other party is at fault, the most efficient path is for you to work directly with their carrier for all property damage and rental needs. We can open a claim on our end, but it will be for record-keeping purposes unless the other carrier denies responsibility. It felt like a punch to the gut. His own insurance company's official advice was to go get help from someone else. It was an abdication of responsibility disguised as a helpful tip. He was paying them for protection, and when he needed it, they were a glorified filing cabinet. This is the first and perhaps most jarring difference between a major standard carrier and many non-standard insurers: the philosophy of service. Major carriers see a claim, especially one where their customer is not at fault, as a moment to prove their value. They have the infrastructure, the capital, and the brand reputation to maintain. They step in immediately, solve the customer's problems, and then they go after the other insurance company for reimbursement behind the scenes. They take the burden off of you. It's called subrogation, and they are masters at it. Many non-standard companies, on the other hand, operate on a razor-thin margin. Their business model is built around minimizing payouts and operational costs at every turn. A claim is not a customer service opportunity. It's a cost center. Their first move is often to deflect, delay, or direct you elsewhere, because every action they take, every phone call they make, costs them money. Forcing you to deal with the other company saves them time and resources. Even if it leaves you, they're paying customers stranded and confused. Over the next 2 weeks, this difference became Mark's living nightmare. The other driver's major insurance company was a dream. His adjuster, Sarah, called him every other day with updates. The rental car was seamless. They sent an appraiser to the tow yard within 48 hours. The appraiser declared his car a total loss and sent him a detailed valuation report. They calculated the actual cash value, or ACV, based on recent sales of comparable vehicles in his area from reputable sources like dealerships. The offer they made was fair. It was enough to pay off his small remaining loan and have a decent down payment for another car. They were ready to cut him a check. But there was a problem. Huge one. Because the other driver's policy had a property damage limit of $25,000. Mark's car was worth about $18,000, and the other driver's car, which was also totaled, was worth about $15,000. That's $33,000 in damages, but only $25,000 of coverage. This meant there wasn't enough money in the at-fault driver's policy to pay for everything. Suddenly, Mark had no choice. He had to go back to his own insurance company, Quick Cover, and use his own collision coverage. He had to step back into the nightmare. He called Steve. Except Steve wasn't his adjuster. He was just the guy who answered the phone that first day. Mark was assigned a new person, someone in the total loss department, who he could only communicate with through a generic email address. There was no direct number. He explained the situation in a detailed email. 2 days later, he got a one-sentence reply. "We have received your request and will dispatch an appraiser. You will be notified of the results." Notified was the key word. There was no collaboration, no conversation. A week went by. Silence. Mark was paying for his rental car out of pocket now, because the other company's obligation ended once their policy limit was reached. He emailed his adjuster every day. "Any update? Following up. I really need to know what's happening." Most emails went unanswered. When he did get a reply, it was a curt, "The matter is under review." Finally, 10 days later, an email landed in his inbox. The subject line: "Valuation report for your claim." This was it. The moment of truth. He clicked it open, his heart pounding. He scrolled past the boilerplate language to the final number. And he stared. He stared and stared, convinced it was a typo. The valuation from Quick Cover for his car, the exact same car the other insurer had valued at $18,000, was $9,500. It was barely half. It wasn't enough to pay off his car loan. It would leave him thousands of dollars in debt with no car and no money for a down payment. It was a financially devastating, life-altering number. And at the bottom of the email in cold digital print was the single sentence from his policy that explained everything and left him with absolutely nothing. The sentence read, "Coverage under this policy is strictly limited to the named insured, listed on the declarations page, and does not extend to any other person operating the insured vehicle, regardless of expressed or implied permission." Let that sink in. It's corporate jargon. It's legalese. It's the kind of sentence we all see in contracts and just scroll past. We assume it's standard. We assume it means nothing. But for David, it meant everything. It was a contractual kill shot. What it meant in plain English was this. The insurance policy he had been paying for every single month only covered one person on planet Earth, David. Not his girlfriend. Not his brother who might need to borrow the car in an emergency. Not his mom if she needed to run to the store. Just him. David had purchased what's known as a named driver policy, and he had no idea. This is, without a doubt, one of the single biggest and most dangerous differences between many non-standard insurance companies and their major standard line counterparts. It's a trapdoor built into the very foundation of the policy, and most people don't know it's there until they've already fallen through it. Most of us, when we think of car insurance, we think of what the major carriers sell. We think of permissive use. It's a simple concept. If you own the car and you have a policy with, say, Geico or Progressive, and you give your friend permission to borrow your car, your insurance generally covers them. The insurance follows the car. It's intuitive. It's how we think it should work. You trust your friend, you lend them your car, and your policy, which you paid for, protects your car. Simple. Major insurance companies operate this way because they have a massive pool of data. They've analyzed millions of drivers and accidents over decades. They know that, on average, the friends and family members you lend your car to are probably similar in risk to you. They build the cost of that potential risk, the risk of your friend getting into an accident, into the premium you pay. You're paying a little bit more for that flexibility, for that peace of mind. Non-standard companies, however, play a different game. Their entire business model is built on surgically removing risk. They are ensuring a higher risk pool of drivers to begin with, so they can't afford to take on unknown risks. And your girlfriend, your cousin, your best friend? To them, that is a massive, unknown risk. They haven't run their driving record. They haven't checked their credit score. They haven't put them through their underwriting algorithm. They know nothing about them. So, they eliminate that risk entirely with a named driver policy. They are not insuring your 2018 Honda Accord. They are insuring you and only you while you are driving your 2018 Honda Accord. The moment someone else gets behind the wheel, the policy might as well not exist. For David, this was a nightmare. His girlfriend had a perfect driving record. She was a safer driver than he was. In his mind, letting her drive was the responsible thing to do. But his insurance company didn't see a responsible girlfriend. They saw an unlisted, ununderwritten, unknown variable. And their policy was designed with a single brutal purpose: to eliminate variables. So when the claims adjuster got the file, the process was tragically simple. Step 1. Who was driving the vehicle? A Ms. Emily Carter. Step 2. Is Ms. Emily Carter the named insured on the policy declarations page? No. Step 3. Deny claim. Close file. There was no discussion, no negotiation, no empathy. Just a cold, contractual execution based on a single sentence buried on page 14 of his policy packet. He had paid his premiums on time for 2 years, believing he was protected. In reality, he was only protected under a very specific, rigid set of circumstances that didn't apply on the one day he actually needed it. This brings us to the next colossal difference, one that goes far beyond the policy wording and gets into the very culture of these companies: the claims experience. When you have an accident, you are at your most vulnerable. You're stressed, maybe injured, and your life has been thrown into chaos. The last thing you need is a battle. You need an ally. Major standard insurance companies spend billions, literally billions of dollars on advertising every year. And what are they selling you? Are they selling you complex liability limits and deductible schedules? No. They're selling you a feeling. They're selling you trust. They're selling you Flo from Progressive, the Geico Gecko Jake from State Farm. They are selling you a promise that when things go wrong, a friendly, competent person will be there to make it right. Their entire brand reputation is built on the claims experience. This doesn't mean they're perfect, of course not. But their business model depends on customer retention and positive word of mouth. A smooth, fair claims process is their #1 marketing tool. They invest heavily in training their adjusters, in building sophisticated apps to streamline the process, and in creating a customer service infrastructure that feels supportive. When you call them, you're typically speaking with a direct employee of that company, working in a dedicated claims center, whose performance is judged on customer satisfaction as much as it is on closing the claim. The non-standard world can be different. The experience can feel less like calling an ally and more like entering a deposition. Many non-standard insurers keep costs down by outsourcing their claims handling to third-party administrators, or TPAs. These aren't employees of the insurance company you bought your policy from. They are separate companies whose job is to process claims for multiple insurers as cheaply as possible. The person on the other end of the line might be handling claims for 5 different non-standard companies at once. They have no investment in the brand reputation of David's Bargain Auto Insurance. Their primary directive is to process the claim according to the strict letter of the policy and close the file as quickly and inexpensively as possible. The adjusters often have enormous caseloads, sometimes hundreds of active claims at once. They don't have time for hand-holding. They don't have the latitude to make exceptions. They are trained to find any available exclusion in the policy that could limit or deny the payout. Remember that sentence in David's policy? The TPA adjuster's job was to find it and apply it ruthlessly. The entire interaction feels adversarial because, from a business perspective, it is. You are a cost center. Your claim is a liability on their balance sheet. Every dollar they pay you is a dollar less in profit. While this is technically true for all insurance companies, the major carriers balance this against the long-term value of keeping you as a happy customer who will pay premiums for years and tell your friends. For many non-standard carriers, customer retention isn't the primary goal. Acquiring new customers who need the absolute cheapest state minimum policy is the goal. They know many of their customers are transient and will switch companies for a $5 a month difference. So, there's less financial incentive to invest in a world-class white-glove claims experience. Think of it like this. The major carrier is trying to build a long-term loyal relationship with you. The non-standard carrier is often engaged in a short-term transactional exchange. You pay the bare minimum for a policy, and they provide the bare minimum of coverage, enforced by a bare minimum cost claims process. For David, this meant his one and only phone call with the adjuster was cold, brief, and final. He tried to argue. He tried to explain that it was an honest mistake, that he didn't understand the policy. The adjuster simply stated, "Sir, the policy language is clear. We are denying the claim based on the unlisted driver exclusion. A formal letter will be mailed to you." And that was it. Click. He was left with a wrecked car, a 5-figure bill for the other driver's damages, and the sickening realization that the safety net he thought he had was an illusion. The cheap premium he was so proud of finding wasn't a good deal. It was a price tag for a different kind of product altogether. He hadn't bought a smaller version of the same insurance his parents had. He had bought a completely different thing with different rules, different goals, and a dramatically different outcome. And the scary part is these are just 2 of the differences. We've talked about the fine print in the policy and the experience of filing a claim. But what happens when the accident is so big, it tests the very financial foundation of the company you paid. Can they actually afford to pay you? The answer is terrifying. The terrifying answer is, sometimes no. They can't. An insurance policy is at its core a promise. It's a piece of paper that says if something terrible happens, a company with a big impressive-sounding name will make you whole. But a promise is only as strong as the person or the corporation making it. And sometimes that promise is written on air. To understand how fragile that promise can be, we have to go back to August 24, 1992. In the dead of night, a monster named Hurricane Andrew slammed into South Florida. This wasn't just a storm. It was a civilization-level event. Winds hit 175 miles per hour. They didn't just break windows, they ripped entire homes from their foundations. Steel-reinforced concrete light poles were snapped in half like twigs. The storm's surge turned coastal towns into extensions of the Atlantic Ocean. When the sun rose, it revealed a landscape that looked like it had been bombed. Over 60,000 homes were destroyed. 250,000 people were left homeless in a single night. The human toll was immense. But a second invisible storm was just beginning to brew. This was a financial hurricane, and it was about to hit the insurance industry with the force of a Category 5. The total insured losses from Andrew were over $16 billion. In today's money, that's more than $30 billion. It was, at the time, the costliest natural disaster in U.S. history. And the insurance companies started to fall. One by one they began to fold. They had written thousands of policies, collected thousands of premium checks, and made thousands of promises. But when it came time to pay, the money simply wasn't there. The sheer number of claims, all at once, was like a nuclear bomb detonating in their balance sheets. 11 insurance companies in Florida went insolvent. They went bankrupt. They ceased to exist. Imagine that. You pay your premium dutifully for years. Your house is destroyed. You call the number on your policy document, the one you were told to call in an emergency, and the line is dead. The company is gone. Your promise has vanished. This is the single biggest, most important, and least understood difference between a major, national carrier and many smaller, non-standard companies. Financial solvency. It's the ability to withstand a catastrophe. It's the ability to pay out 10,000 claims at the exact same time without even flinching. So how do the big guys do it? How can a company like State Farm or Allstate survive an event that wipes out a dozen of their competitors? The answer is a one-two punch of financial fortitude and a secret weapon the average person has never even heard of. First, let's talk fortitude. You've probably heard of credit scores for people, right? A FICO score tells a lender how likely you are to pay back a loan. Well, there are credit scores for insurance companies too. The most respected rating agency is called AM Best. For over a century, they have done nothing but analyze the financial health of insurance companies. They dig through their books, look at how much cash they have on hand, their reserves. They analyze the quality of their investments, and they stress test their ability to handle major disasters. Then they issue a grade. Just like in school. An A++ or A+ rating from AM Best is the gold standard. It's a seal of approval that says this company has superior financial strength and can meet its obligations to policyholders, come hell or high water. Literally, the major national carriers live and die by these ratings. They brag about them in their commercials. A downgrade from AM Best can send shockwaves through their stock price. Now go look up the AM Best rating for that super cheap, non-standard insurance company you saw on a billboard. You might find they have a B rating, which means fair or adequate. Or you might find they have no rating at all. They are too small or too new for AM Best to even bother analyzing. That doesn't automatically mean they're going to go bankrupt, but it does mean their financial strength is, at best, unverified. You are flying blind. You are trusting a promise from a company that the world's leading expert hasn't even given a passing grade. But even a huge pile of cash and an A++ rating isn't enough to survive another Hurricane Andrew. That's where the secret weapon comes in. It's called reinsurance. Reinsurance is, quite simply, insurance for insurance companies. Think of it like this. A bookie in Vegas takes $1 million bet on the Super Bowl. If he loses, he's wiped out. That's too much risk for one person to hold. So what does he do? He lays off the bet. He calls other bookies and has them take a piece of the action. He might pay them $100,000 to cover half the bet. Now his potential loss is cut in half. He spread the risk. That is exactly what major insurance companies do, but on a global scale. A company like Geico might insure 1 million homes in California. They know that a massive earthquake could, in theory, force them to pay out hundreds of billions of dollars at once. That much concentrated risk could bankrupt even them. So, they go to a reinsurer, a massive, often foreign-based company like Swiss Re or Munich Re, financial titans you've never heard of, and they buy an insurance policy on their own policies. They might pay the reinsurer $1 billion a year. In exchange, the reinsurer agrees that if a disaster causes more than, say, $5 billion in losses for Geico, the reinsurer will pay everything above that amount. They have just put a cap on their maximum possible loss from a single event. It's an incredibly expensive safety net, but it allows them to sleep at night. It allows them to survive the unthinkable. This is a world that most non-standard carriers simply don't operate in to the same degree. Their business model is different. They aren't trying to insure against a once-in-a-century catastrophe. They often lack the scale, the capital, and the global relationships to purchase the same level of reinsurance as the giants. Their safety net is smaller with bigger holes. They might be able to handle a bad winter with a lot of fender benders. But a major hailstorm that damages 10,000 cars in one city in one afternoon? A tornado outbreak? That could be an extinction-level event for them. Now you might be thinking, okay, but surely the government wouldn't let me be left with nothing, right? There has to be some kind of backstop. And you're right. There is. It's called a state guarantee fund. Every state has one. And if your insurance company goes bankrupt, this fund is supposed to step in and pay your claims. Sounds great, right? It's not. Relying on the state guarantee fund is the absolute last resort. A financial nightmare you want no part of. First of all, these funds are not backed by the full faith and credit of the state government. They are funded by levying fees on the other, healthy insurance companies operating in that state. It's basically a bailout plan where the responsible companies are forced to clean up the mess left by the irresponsible one. Because of this, there are strict limits. Most state funds cap the payout per claim, often at $300,000. So if you have $1 million liability claim against you from a horrific accident, you're only getting a fraction of that covered. The rest? That's on you. Your house, your savings, your future wages, they could all be on the line. And even if your claim is under the cap, get ready to wait. The process is excruciatingly slow. When a company goes belly up, the state has to come in, seize the assets, and sort through a mountain of paperwork and mangled records. Your claim isn't against an insurance company anymore. It's against a slow-moving government bureaucracy. Can take months, sometimes years, to get your money. Meanwhile, your car is still wrecked. The hospital bills are still arriving. The person you injured is still suing you. Choosing an insurer with a weak financial rating is like walking a tightrope without a net, but convincing yourself it's okay because there's a pile of old mattresses on the ground 50 feet below. Sure, it's better than nothing, but the fall is still going to hurt, and you might not walk away in one piece. This is the hidden risk. This is what you don't see when you're just comparing two price quotes online. You are not just buying a product. You are buying a financial backstop for the worst day of your life. And you have to ask yourself, is the company I'm paying built on a foundation of solid rock, with A-rated financial strength and a global web of reinsurance? Or is it built on sand, one bad storm away from being washed out to sea, leaving you and your promise stranded? So you've done your homework. You've checked their AM Best rating. You've chosen a company that can financially survive a disaster. But the reality is, most of us will never experience a Hurricane Andrew. Our interactions with our insurance company are much more mundane. They happen at 2 in the morning on a rainy highway, or on a frustrating phone call trying to add a new driver to our policy. And in these moments, the company's financial solvency doesn't matter. What matters is their technology, their accessibility, and their customer service. And the difference between the majors and the non-standards in this arena can be just as shocking as a company going bankrupt. And it's something you're far more likely to experience firsthand. Let's start with a simple, incredibly common scenario. You're driving to work, you get pulled over for a broken taillight, and the officer asks for your license, registration, and proof of insurance. Your heart sinks. You just cleaned out your glove box and you have no idea where that little piece of paper is. What do? If you're with a major carrier like Geico, Progressive, or State Farm, the answer is simple. You pull out your phone, open their app, and in less than 10 seconds, a digital ID card is glowing on your screen. The officer glances at it, hands you a warning for the taillight, and you're on your way. The entire interaction is a minor, 30-second inconvenience. Now let's replay that scene. But this time you're insured by a lesser-known, non-standard company you found online because it was $70 cheaper a month. You pull out your phone, you search for their app, and there isn't one. Or maybe there is, but it's a clunky one-star disaster that's just a portal to their non-mobile-friendly website. You try to log in, but you can't remember your password. You try to reset it, but the email isn't coming through. The officer is tapping his foot. You try calling the 1-800 number on the back of an old bill you found crumpled under the seat. You're greeted by a robotic voice menu. After navigating 5 different options, you're placed on hold, listening to distorted elevator music. 10 minutes go by. The officer's patience is gone. That warning for a broken taillight has now escalated into a ticket, or worse, a citation, for failure to provide proof of insurance. This single simple scenario reveals the massive fundamental chasm that exists between major and non-standard insurers when it comes to technology and customer experience. It's not just about fancy features. It's about accessibility and peace of mind in the moments you need it most. The major carriers aren't just insurance companies anymore. They are, in many ways, tech companies. They pour hundreds of millions, if not billions, of dollars into their digital infrastructure. Their apps are sophisticated tools designed to make your life easier. You can pay your bill, change your coverage, add a new car to your policy, and even file a claim, complete with photos and a recorded statement, all while standing on the side of the road. If you need roadside assistance, the app uses your phone's GPS to pinpoint your location and shows you a map with the tow truck's real-time ETA, just like Uber. This isn't just convenience. It's a safety and security feature. It's an ecosystem designed to be seamless, intuitive, and most importantly, functional when you're under stress. Non-standard companies, on the other hand, operate on a completely different business model. Their primary and often only competitive advantage is price. To achieve those rock-bottom premiums, they have to slash costs everywhere else, and technology is one of the first and biggest things to go on the chopping block. Developing and maintaining a high-quality app and a robust website is incredibly expensive. It requires teams of developers, designers, and cybersecurity experts. For a non-standard carrier, that's a luxury they simply cannot afford. The result is a user experience that often feels like a time capsule from the early 2000s. Forget filing a claim through an app. You're lucky if you can even download a PDF of your policy. Making a simple change like updating your address might require you to call your agent, who only works from 9 to 5, Monday through Friday, and then wait 24 to 48 hours for the change to be processed and a new document to be mailed to you. In an age of instant gratification, this level of friction is jarring. The money you save on the premium is paid for with your time and your patience. But this digital divide is only the beginning. It's what happens when the technology fails, or when your problem is too complex for an app, that the second major difference comes into sharp focus: customer service. What happens when you actually need to speak to a human being? With a major carrier, you have a wealth of options. You can call a 24/7 national hotline. You can use a live chat feature on their website. You can email a dedicated support team. Or if you have one, you can call or walk into the office of your local agent, a person who often knows you and your family. These companies have invested in massive, technologically advanced call centers with thousands of employees. They use sophisticated systems to route your call to the right department, and their representatives are generally well-trained and empowered to solve a wide range of problems on the spot. It's not always a perfect experience. We've all had frustrating calls with big companies, but the infrastructure for support is there. The system is built for accessibility at scale. Now, contrast that with the typical non-standard experience. Their customer service is another area where cost-cutting is painfully obvious. You'll likely find their call center is only open during limited business hours. Have a serious accident at 10 p.m. on a Friday? You might not be able to report it or speak to anyone who can help until Monday morning. When you do call, be prepared for long hold times. These centers are often deliberately understaffed to save money. The person you finally speak to may be a low-paid employee with minimal training, reading from a script, with little to no authority to actually help you. Their primary job is to act as a gatekeeper for the claims department. The agent who sold you the policy? They're often just an independent broker who has no power to assist with claims or service issues. They got their commission, and now you're on your own, lost in a bureaucratic maze. This is the very definition of being just a number. You're a policy number and a monthly payment, and when a problem arises, you are a cost to be managed, not a customer to be helped. This brings us to the ultimate test of any insurance company, the one moment that truly defines their value: the claims process. This is the moment of truth. This is what you have been paying for all along. And it is here that the difference between a major and a non-standard carrier becomes a life-altering event. When you file a claim with a major insurer, you are activating a well-oiled, highly efficient machine. You can often start the process on your app. A claims adjuster is assigned to you quickly, sometimes within hours. They have a clear step-by-step process. They have established networks of pre-approved, reputable body shops. You can take your car to one of their concierge service centers, where they handle everything from the estimate to the rental car to the repairs, and they guarantee the work. They pay the shop directly. The entire process is designed to be as fast and painless as possible. Why? Because their business model relies on customer retention. They want you to be so happy with the service that you'll stay with them for years and recommend them to your friends. They're playing the long game. Filing a claim with a non-standard insurer can feel like you're declaring war. From the very first call, the process can be adversarial. Remember, their model is built on minimizing payouts. Every dollar they don't pay you is a dollar that goes straight to their bottom line. So they use a playbook of delay, deny, and defend. First comes the delay. Your adjuster might be impossible to reach. Calls go unreturned for days, even weeks. They'll request the same document multiple times. They'll tell you it's under investigation. These delays aren't just frustrating. They're a strategy. They know you need your car fixed. They know you need to get back to work. The longer they drag it out, the more desperate you become. Next comes the offer. After weeks of waiting, you'll finally get an estimate, and it will likely be a shockingly low number. They use outdated pricing for parts and labor, or they'll claim that some of the damage was pre-existing. They'll offer you a check for a fraction of what the body shop quoted, hoping you're so desperate for any amount of money that you'll just take it and go away. And if you fight it, you're in for a battle. You have to spend your own time getting multiple quotes, arguing with adjusters who are trained to say no, and documenting everything. There are no preferred shops, because reputable body shops often refuse to work with these companies, knowing they'll have to fight for months to get paid. So you're on your own, caught between a mechanic who needs to be paid and an insurance company that's treating you like a fraud. This is the hidden cost. The true price of that cheap insurance isn't measured in dollars, but in stress, in time, and in the profound sense of abandonment you feel when the company you paid to protect you does everything in its power to do the opposite. The sleek app, the 24/7 service, the guaranteed repairs, these aren't just perks. They are the core of the product. With a major, you're buying a promise of restoration. With a non-standard, you're often just buying a piece of paper that keeps you legal, and a ticket to a world of frustration when you actually need to use it. Let's walk through that world of frustration. Imagine a man named David. David is a responsible guy, works a steady job, but money's tight. He shopped around for car insurance and found a non-standard policy that saved him $40 a month. He felt smart. He was beating the system. 6 months later, he's sitting at a red light and bam, he's rear-ended. The other driver is clearly at fault. Their major insurance company accepts liability immediately. David thinks, great, this should be easy. He calls his non-standard company to get the process started for his repairs. And that's when the nightmare begins. First, getting his own adjuster on the phone is a battle. Voicemails go unreturned for days. When he finally connects, the adjuster is dismissive, treating him like an inconvenience. The other driver's major insurance company sends an appraiser out the next day. But David's company insists on sending their own independent appraiser, who can't make it for another week. For a full week, his car with a crumpled trunk and a broken taillight just sits. He's already borrowing his brother-in-law's car to get to work. When the estimate finally comes in, it's a joke. It's $1,000 less than the body shop's quote. Why? Because his non-standard policy, buried in the fine print he never read, allows the company to mandate the use of like-kind and quality parts. That's industry jargon for junkyard parts. The body shop owner pulls David aside and says, look, I can put this used bumper on, but it's from a car that was in a flood. The sensor inside is probably shot. We can't guarantee the work. David's car is only 3 years old. He's supposed to accept a rusty, water-damaged part on his car to save the insurance company a few $100s. He tries to fight it. He spends hours on the phone, getting transferred from department to department. Each person he talks to gives him a different story. Meanwhile, the clock is ticking on his rental car coverage. His policy has a paltry $30 a day limit, capped at a total of $500. That runs out in about 2 weeks. The fight over the junkyard bumper takes 3 weeks. For that last week, and the 2 weeks it finally takes to repair the car, David is paying for a rental out of his own pocket. That $40 a month he saved? It's gone. He's already $200 in the hole just on the rental. Not to mention the value of his car is now diminished because it's been repaired with salvaged parts. He won, right? He saved money. Now let's rewind. Imagine David had paid that extra $40 a month for a policy with a major, reputable carrier. He gets rear-ended. He pulls out his phone, opens the company's app, and files the claim right there at the scene, uploading photos of the damage. Before he's even done talking to the police, he gets a push notification. His claim is open, and an adjuster will call him within the hour. The adjuster calls, is empathetic and professional, and says, we have a preferred collision center 2 miles from you. They can get you in tomorrow. We'll have a rental car waiting for you there. Just drop your car off, pick up the rental, and we'll handle the rest. David drops his car off. The body shop and the insurance company work directly with each other. There's no fight over parts because his policy guarantees original equipment manufacturer parts for cars under 5 years old. The rental car is billed directly to the insurance company. He doesn't see a bill. 3 weeks later, he gets a call. His car is ready. It looks exactly like it did before the accident, washed and detailed. He drops off the rental, picks up his car, and drives away. His life was disrupted for about an hour. That's it. That is the product. That is the promise of restoration. One version is a transaction that saves you a few bucks now to cost you thousands of dollars and weeks of your life later. The other is a service designed to make you whole again. This isn't just about convenience. It's about solvency. It's about the fundamental ability of the company you pay to actually pay its bills when disaster strikes. There's a crucial metric that most consumers have never heard of: the AM Best rating. Think of it like a credit score for insurance companies. It's an independent grade of their financial strength and their ability to meet their obligations to policyholders. Major household name carriers, your Allstates, your Progressives, your Geicos, typically have ratings of A+, or even A++. This means they are financial fortresses. They have billions of dollars in cash reserves, specifically set aside to pay claims. They are built to withstand catastrophes. A massive hurricane that floods a whole city, a hailstorm that damages 10,000 cars in an afternoon. Their financial foundation is rock solid. Now, go look up the AM Best rating for many of these non-standard bargain basement insurers. You'll often find ratings of B or B+, which is considered fair or good, but it's a world away from excellent or superior. Some of them aren't even rated at all, which is a screaming red flag. A B-rated company might be fine when the sun is shining and claims are predictable, but they are operating on much thinner margins. They don't have the vast reserves. They are a financial house of cards. One major unexpected event, one regional disaster that causes a surge in claims, can push them to the brink of insolvency. And what happens if your insurance company goes bankrupt? You might think the government will bail you out. And you'd be sort of right. Every state has something called a State Guarantee Association. If an insurer goes belly up, this association steps in to pay their outstanding claims. But here's the terrifying catch. It's not a seamless process and it's not a blank check. First, there are statutory limits on how much the association will pay out per claim, and these limits can be far less than the cost of a serious accident, especially if there are medical bills. Second, the process can take years. Your claim gets thrown into a bureaucratic black hole, while the company's assets are liquidated. The body shop that fixed your car isn't going to wait 2 years to get paid. They're going to send you to collections. The hospital that treated your injuries, their bill is coming to you. You, the victim of an accident, are now left holding the bag for your own insurance company's failure. That cheap policy is now threatening you with financial ruin. This is the hidden risk. It's the systemic foundational difference between a company built to last and a company built to sell cheap policies and hope for the best. The consequences of a bad claims experience ripple through your entire life. It's not just the money for the rental car. It's taking unpaid time off work to sit on the phone arguing with an adjuster. It's the stress that puts a strain on your marriage. It's the damage to your credit score when a medical bill you thought insurance was covering goes to collections. It's the awful sinking feeling of being powerless, of knowing you've been had, and there's nothing you can do about it. The old saying, penny wise and pound foolish, has never been more true than in the world of auto insurance. That small monthly savings is a bet. You are betting your car, your savings, your credit, and your peace of mind that you will never be in a serious accident. And it's a sucker's bet, because you have no control over the other drivers on the road. You're paying for a product whose only purpose is to perform at the worst moment of your life. Choosing the cheapest possible option is like hiring the cheapest possible surgeon. You might save some money if nothing goes wrong, but you're praying nothing goes wrong. So how do you avoid this trap? How do you navigate this minefield and find a company that offers a fair price without sacrificing the very protection you're paying for? How do you ensure you're buying a promise, not a problem? That's what we're going to break down next. The ultimate checklist for choosing the right insurance company for you. Alright, let's build that checklist. This is the 7-point inspection you need to run on any potential insurance company, whether it's a household name or a specialist you've never heard of. Forget the commercials, forget the mascots. This is about what happens when you actually need them. First, and this is non-negotiable, check their financial health. An insurance policy is only as good as the company's ability to pay its claims. A rock-bottom price from a company on shaky financial ground is like buying a lottery ticket that's already expired. The gold standard here is the AM Best rating. Think of it like a credit score for insurance companies. You're looking for a rating of A or better. A dash is acceptable, B+ is a bit of a yellow flag, and anything lower should make you seriously reconsider. You can often find this rating right on their website, but you can also look it up independently. A company that can't pay for your totaled car or your medical bills isn't providing insurance. They're just collecting premiums. Second, investigate their claims and customer service reputation. This is the moment of truth. A great price means nothing if you have to fight tooth and nail for months to get a claim paid. Start with the big guns. J.D. Power and Consumer Reports. They do large-scale, data-driven studies on customer satisfaction, especially regarding the claims process. Then move on to the Better Business Bureau. Look at the number of complaints relative to the size of the company, and more importantly, see if there's a pattern. Are all the complaints about slow payouts? Denials for strange reasons? Poor communication? 1 or 2 disgruntled customers is normal. 100 telling the exact same horror story is a massive red flag. And yes, read online reviews, but do it with a grain of salt. People are far more likely to complain than to praise. Instead of getting swayed by one emotional story, look for recurring themes. If you see dozens of people mentioning lowball offers or unreturned calls, you're seeing the smoke from a real fire. Third on our checklist, scrutinize the coverage options and flexibility. The cheapest policy is often the most rigid. Does the company only offer the state minimum liability? Or can you customize your policy to fit your life? Look for add-ons, often called endorsements. Can you get rental car reimbursement? If your car is in the shop for 2 weeks after an accident, paying for a rental out of pocket can cost you over $1,000. What about roadside assistance or towing coverage? Or gap insurance, which is critical if you have a loan on a new car? A good insurance company, major or non-standard, should offer a suite of options that let you build a policy that protects your specific situation, not just a generic template. If they can't, you might outgrow them the moment your life changes. Fourth, you need to become a discount detective. Don't just accept the first quote they give you. You have to actively hunt for savings. Many people leave hundreds of dollars on the table every year because they just don't ask. Go down the list. Are you a good student? Is there a discount for that? Did you take a defensive driving course? Ask. Do you have winter tires? Anti-theft device? Ask. Are you a member of a specific alumni association, union, or professional group? Ask. The biggest one is often bundling. Combining your auto and home or renter's insurance can slash your premium. But even here, do the math. Sometimes, 2 separate policies from 2 different companies are still cheaper than one company's bundle discount. The key is to be proactive. Make them work for your business by proving they can give you every single discount you qualify for. Number 5 is arguably the most important, and it's where most people get burned. You must understand the fine print, the gotcha clauses. An insurance policy is a legal contract. Let's look at 3 big ones. First, named driver versus permissive use. A permissive use policy, common with major carriers, generally covers anyone you give permission to drive your car. A named driver policy, often found in the non-standard market to keep costs down, covers only the drivers explicitly listed on the policy. If you let your cousin borrow your car to run to the store and they get in an accident, a named driver policy could leave you completely uncovered, on the hook for everything. Second, look for the aftermarket parts clause. After a claim, is the insurer obligated to use original equipment manufacturer, or OEM parts? Or can they use cheaper aftermarket parts? For an older car, it might not matter. For your 2-year-old truck, it could affect performance, safety, and resale value. Third, look for specific exclusions. Does the policy cover you if you're driving for a rideshare or food delivery service? Almost all personal policies do not, unless you add a specific endorsement. Reading these details isn't fun, but knowing about them before a claim can be the difference between a minor inconvenience and financial ruin. Sixth on the inspection list is a modern necessity: the digital experience. How easy is it to do business with them? In today's world, you shouldn't have to wait on hold for 45 minutes to get a copy of your insurance ID card. Check out their website and, more importantly, their mobile app. Can you view your policy documents? Make a payment? Can you file a claim and upload photos directly from your phone at the scene of an accident? A clunky, outdated app isn't just an annoyance. It can be a sign that the company isn't investing in customer convenience. A smooth, intuitive digital experience suggests a company that respects your time and is focused on making your life easier, which is exactly what you want when you're stressed out after an incident. Finally, number 7, and this is specifically for those navigating the non-standard market. Ask about their process for SR22s or FR44s if you need one. These aren't types of insurance, but rather certificates that the insurance company files with the state to prove you have coverage. A delay or a mistake in this filing can cause the DMV to suspend your license, creating a nightmare scenario. A company that specializes in non-standard insurance often has this process down to a science. They know exactly who to contact at the DMV and how to get the filing done instantly. A major carrier might see it as an infrequent, annoying piece of paperwork, and you don't want to be the person whose driving privileges are in limbo because of a clerical error. So if this applies to you, ask them directly. How quickly do you file in State Route 22, and what's your process to confirm it's been received by the state? So there it is, the 7-point inspection. Financial stability, customer reputation, coverage flexibility, discount hunting, fine print gotchas, digital experience, and state Route 22 process. By now, you should see that the question isn't, are major insurance companies good and non-standard companies bad? That's the wrong way to look at it. The real question is, which company is the right fit for my specific needs, my driving record, and my budget, and has the integrity to back up its promises? A major carrier might be the perfect, cost-effective choice for a family with multiple cars, a clean record, and a home to bundle. But for a young driver with a speeding ticket, or someone rebuilding their credit, a non-standard company that understands their situation might not only be cheaper, but also provide a smoother, more specialized service. The goal is to move from being a passive price shopper to an educated insurance buyer. You're not just looking for the lowest number, you're looking for the best value. You're buying financial security. You're buying peace of mind. And now you have the tools and the knowledge to look past the advertising, to read between the lines of a policy, and to choose a company with confidence. You're equipped to find a policy that doesn't just meet the state's requirements, but that truly protects you and your family when you need it most. Drive safe and choose wisely.